So, you're getting ready to make one of the biggest financial decisions of your life, what to do with your pension. You're probably focused on that lump sum number versus the monthly check. But what if I told you there's a hidden factor, a single number, that can totally change the value of that pension? Yeah, understanding this one thing is absolutely key.
It really begs the question, how much is your pension actually worth? Because spoiler alert, it is not a fixed number. Nope, it's moving all the time, and the force behind that change is exactly what we're going to break down right now.
Get this, a tiny 1% change in interest rates can slash your lump sum offer by 10 to 20%. I mean, that's a huge deal. For a lot of people, that could be tens of thousands, even hundreds of thousands of dollars, just gone, all because of timing. So let's get into exactly why this happens.
The easiest way to think about this is what I call the interest rate seesaw. It's a really simple idea, but it's so powerful, and it's what dictates the size of that lump sum offer you're looking at.
Okay, so the technical term here is the discount rate, but don't let the jargon scare you. All it is the number your employer uses to figure out how much cash they need to have in the bank today to be able to pay you for the rest of your life. It's basically the today value of all your future checks.
And this right here is the seesaw in action. It's a perfect picture of what's going on. When interest rates go up, your company can earn more on its investments. That means they don't need to set aside as much money today to fund your future, so your lump sum offer shrinks. But when rates fall, the opposite happens. They need more cash up front, so your lump sum offer grows. See? Simple as that.
All right, so now that we get the mechanics of how this works, let's talk about the big decision. How do you use this knowledge to decide between the lump sum or that steady monthly check?
Well, here's a great little rule of thumb. When interest rates are low, your lump sum is naturally going to be bigger, which makes taking the cash a really compelling option. But when rates are high, that lump sum shrinks, and suddenly that guaranteed monthly payment starts looking a whole lot better in comparison. But here's the thing. While all this math is super important to understand, this decision, it isn't just about the numbers. Not even close. It's deeply personal, and it has to fit your life.
You know, the best choice for you has to line up with what you actually want your retirement to look and feel like. Are you someone who wants control, flexibility, or is leaving a legacy the most important thing? These are the questions that really matter.
So you've got to ask yourself, do I want total control over this big pot of money? Or am I more comfortable with a guaranteed no-fuss check every month? Is leaving money to my kids a must-have? Because remember, a pension usually stops when you and your spouse are gone. What about flexibility for life's curveballs? Or is that second stream of guaranteed income, right alongside Social Security, the thing that will let you sleep at night? Your honest answers here are your true guide.
Now, the good news is, no matter which way you're leaning, there are some really powerful strategies you can use to protect your choice, and maybe even get the best of both worlds. So let's say you love the idea of that big lump sum, but you're nervous about giving up a guaranteed income for life. Well, there's a fantastic solution for that. You can actually create your own personal pension using a tool called a Guaranteed Lifetime Withdrawal Benefit, or GLWB for short. And the process is really straightforward. It's basically 3 simple steps. You take your lump sum from your company, you place it into a special type of annuity that has this GLW feature, and bam, you've created your own personal pension that you control.
And you can see all the advantages right here. A GLW gives you that lifetime income you wanted. But unlike a traditional pension, it also gives you the potential for your money to grow. It leaves a legacy for your heirs, and it gives you flexibility and ownership, things a corporate pension just can't offer.
Now, protecting your decision is about more than just your income stream. A truly rock-solid retirement plan also needs a safety net for some of life's biggest what-ifs.
And this is where insurance becomes so critical. Think of it like this. Life insurance is there to protect your family if you die too soon, replacing your income. And on the flip side, long-term care insurance protects your savings if you live a really long time and need expensive care. Together, they create a fortress around your financial plan.
Okay, we've covered a lot of ground. The impact of interest rates, the personal side of things, and some powerful tools for protection. So let's pull it all together into a clear, simple action plan for you.
So, what are your next steps? Here's a quick checklist. First, compare your lump sum offer at different interest rate levels. Next, really stress test your whole retirement plan to see how it holds up. Definitely explore if a GLWB could give you a better outcome. And of course, take a serious look at your insurance needs. But maybe the most important step of all, talk to an independent expert, Someone who works for you, not your employer, who has their own interest at heart.
Look, I know making this choice can feel pretty overwhelming, but you absolutely do not have to figure this out on your own. If you'd like an expert to help you compare all your specific options, from your lump sum to a potential GLWB or finding the right insurance products, that's what we're here for. Here at the Annuity Expert, our services are always completely free. Just give us a call at 770-755-1565 or find us online. We'd be happy to give you the clarity you need to make a decision you can feel great about.